Shall we continue? Let's do a little recap, shall we? I think we left, what, did we get through,
The conventions?
I'm sorry?
We went through the conventions.
We went through.
I would say the last thing I wrote was just starting. We're going to start the depreciation methods.
Okay, cool. So, remember, there are 4 things that we need to know, when we're depreciating assets for tax purposes. We need to know the basis, and we went through that, cost of the asset, plus any cost to get it ready to actually use. Depreciation periods, otherwise known as asset class lives, and remember the IRS determines what those are based on the type of asset it is. Most common depreciation or asset class lives, 7-year, 5-year, 27.5-year, 39-year, most common. Now there are lots of others as well, and again, so the list is quite extensive, more extensive than what's in your textbook, obviously. And then our depreciation conventions. We had our mid-month convention, which is used for real property being real estate. So that would be whether it's residential, rental type property, or office space. Convention, we would be using the mid-month convention, which means we're gonna start depreciating in the middle of the month in which the asset was purchased, and we're gonna stop depreciating in the middle of the month in which the asset is disposed of. Okay, so we're gonna use the same convention. And then we've got the half-year and mid-quarter conventions, which are only used for personal property. Okay? Personal property being anything that isn't real property. So it's not real estate, it's personal property. We've got the half-year and mid-quarter. We can use the half-year, which means we start depreciating as of July 1st of the year, regardless of when we purchased it during the year. As long as we can use that convention, as long as we don't have to use the mid-quarter convention. And we have to use the mid-quarter convention if we have placed in service over 40% of our total personal property for the year during the last quarter of the year. Okay, so we got to do that calculation of was more than 40% of our personal property. We're not including real property here, just personal property. If it was more than 40% of our personal property placed in service during October, November, and December of this year, if so, then we have to use this mid-quarter convention. If not, then we can use the half-year convention. And recall, the mid-quarter convention means we're going to start depreciating it in the middle of the quarter in which it was purchased. So if it was purchased anytime from January 1st through March 31st, we're going to start depreciating it as of February 15th. So for each quarter, we're gonna do that if we have to use that mid-quarter convention. And again, same as for the mid-month convention for the half-year and mid-quarter, we have to, at the time that we dispose of the asset, we have to use the same convention. Okay, so if we dispose of it between January 1st and March 31st, it's as though we disposed of it February 15th. Okay, the year of disposals has a little bit more complication to it, and I'm going to go through an example with you. Those tables, have we looked at the tables yet? Have we used the tables yet? I can't recall. I don't think we have we? Okay, so we're going to be using the tables that are in the appendix of your of this chapter. We're going to be using those in order to do our depreciation calculations. We use those same tables for the first year through the last year, but the last year gets a little complicated because it gets complicated if we dispose of the asset before we fully depreciated it. Okay, then it gets a little bit tricky because those tables assume that you have owned the asset for the entire year, right? So if you have a 7-year asset and you dispose of it in year 3, on the table, the percentage that they give you to multiply by is not the percentage that you have to use. You're gonna have to do a little bit additional calculation because that percentage is assuming you owned it for the whole year, and if you didn't, then you've got a partial year depreciation, which you have to deal with, but I'll show you what I mean, and we'll go through that. Then the last component that we need to talk about is the depreciation method. There are only 3 choices: 200% declining balance, 150% declining balance, or straight line. These methods are built into the tables. You really don't have to worry about what method is being used, okay? Once you find the correct table that you need to use in your calculations, this is already built into it. Now, most assets, most personal property assets are going to use either 200% or 150% declining balance. You do have, your book doesn't talk about this, you do have a choice to depreciate those assets over the straight line method if you wish. Most people don't, because these declining balance methods give you more depreciation in the early years, right? It means you're trading that for less depreciation in future years and in subsequent years, but it's giving you more depreciation up front. All real property uses the straight line method. Okay, we all know straight line's easy, right? But we do have a table for straight line as well. So we don't have to actually, we can just reference the table. We don't have to actually figure out, you know, what percentage we would use for each year. So we'll reference the tables with those. So that, like I said, the depreciation method, but those are the only 3 choices, but it's really not something that you have to worry yourself too much about, like, you know, which method am I going to use? The tables take all of that into account. So that, the thinking is sort of done for you with regard to the depreciation methods. Now, the one thing, the 2 declining balance depreciation methods that are used, and you'll see this in the table, I'll point it out to you when we look at these tables. It says here, so it's not declining balance for the whole term or the whole asset class life. It switches to straight line depreciation at the point that straight line is more beneficial. So you would then depreciate it over the remaining period using a straight line method. Again, that's built into the tables. So you don't have to really think too much about how do I do that calculation, okay? 200% declining balance method is used for 3, 5, 7, 10-year maker's property. Okay, so what the heck is maker's property? Your chapter has mentioned, I think, makers earlier. I didn't define it for you. So makers, M-A-C-R-S. It's an acronym, obviously. Modified, accelerated, cost, recovery, system. Which, by the way, that little slip up will be on the recording too. So. I guess it could have been worse. This is what MAKERS stands for. Modified Accelerated Cost Recovery System. The IRS sees depreciation as cost recovery. You spent the money and now you're recovering through deductions the cost of that property, of that asset. But that's what so when you see this maker's property, this is what they're talking about. There is another type of depreciation system. It's not used anymore. I think it was called acres. It's not, so it was just accelerated cost recovery system. Now they've modified it somehow. But when they talk about makers, they're talking about this depreciation system that we've been talking about. Okay. So if it's 10-year or less, they use the 200% declining balance method. If it's 15 or 20-year, you use 150%. And then for both of them, it switches to straight line in the year in which straight line yields a higher depreciation allowance. So they give you more benefit. I'll show you, and again, I see a little puzzled look on your face, Sam, with that. I'll show you what that looks like in the table. It might make a little bit more sense. Straight line for all real property. Okay? So let's take a look here of how this calculation is done. So first off, the tables, like I said, they're at the back of the chapter. Not at the back of the book, but at the back of the chapter. So, and you're gonna want to bookmark those. I've got sticky, well, if anybody has paper copies, I've got sticky notes otherwise. Bookmark it in your, I think you can bookmark it. Do it through here. Maybe not. I think you'd be able to search. Maybe not. Anyway, before we do this, I wanna look at the tables. Okay, so there are several tables here that we use. And you'll see, so remember when we went through like chapter 1, maybe chapter 2 as well, we were doing some tax liability calculations, we were using the tables, but we had to find the right table to use depending on filing status. We also the tax schedules that we used, we had to again find the right filing status, so we had several different ones we could choose from, but we had to find the right one based on filing status. Well, we have to find the right one here as well. It's not based on filing status though. It's based on convention that we're going to use. Okay, so this first one, so that one, the convention that you use, you do have to determine that. That one you have to decide which convention has to be used. This very first table is our half-year convention. So remember, is that for personal or real property? Personal property, right. So for personal property, that we start depreciation, that we don't have to use the mid-quarter convention. And remember, also, it would be for all personal property placed in service this year. So if we have to use the mid-quarter convention, then we have to use it for all of our personal property, right? If we get to use the half-year convention, we're going to use that for all of our personal property placed in service that year. There's only one table for the half-year convention. It's the very first table that's listed in your book. Okay, so in order to use this table, you have to know, first off, what year you're in, which year you're depreciating it. So if this is the second year that you're depreciating this asset, you're gonna look at recovery year number 2. If it's the first year, you're gonna look at recovery year number 1 to determine which row you're on. The other factor that you need to know is what asset class life you're using. Is it 3-year property, 5-year property, 7-year property? You know, based on which asset class life is going to determine the row that, or the column that you choose, okay? So if we've got a piece of furniture is 7-year property, and we are in our second year of depreciation. So here's the 7-year column. We're gonna look at row 2. Should scroll this down so I can actually reach it. 24.49%. These are percentages. Okay, so if we have a piece of furniture, we're in our second year. We paid, so the basis of this furniture is $3,000. 7-year property, second year, 24.49%. We're gonna multiply that by 24.49%, which gets us, what, 77, how much is that? 700 something. How much?
734.70.
Okay, that's how much depreciation we're gonna take in the second year on that piece of property. That was $3,000. If it was the first year, again, $3,000, same basis, right? Now, 14.29. which is, how much drop?
428.7.
This is in the first year. That's how much depreciation we would take. Now, you can see that the rows stop at, so like for the 3 year, we actually stop at year 4. Well, that's kind of weird. Well, I thought this was 3 year. Remember, we're starting in the middle of a year. So we're starting July 1st, we're not starting January 1st, which means that half of the first year is being taken in the first year, and then half of the last year is being taken in that last year. So don't look at it and be like, that's really weird, I thought this was 3 year property, but it shows depreciation for 4 years. Yes, on a calendar year basis, you're going to go into the 4th year for that depreciation, but it's still 3 full years, right? July 1st to December 31st, 6 months, and then you'd have 2 years that we had January to December, and then that last year would be January to June 30th, which is the other 6 months. Does that make sense? So it is 3 years, but because we're starting in the middle of the year, it shows up as you run into the 4th year. Does that make sense to everybody? Yeah? Okay. So that's why that's kind of weird. Now, like I mentioned, these years, all of these percentages assume that you own that piece of property for the whole year. So this is assuming we didn't sell it in the second year. If we sold it in the second year, we're gonna have to adjust this percentage. Because this is assuming 12 months and we only owned it, and again, it doesn't matter if we sold it January, if we sold it December, we stopped depreciating it as of June 30th. So we only get half a year's depreciation for it. So we're gonna have to cut that in half if we sell it during this year. That's only in the year of disposal. Does that make sense? So the year of disposal, you're gonna have to adjust the percentages that are provided. The year of purchase, you don't. The year you place it in service, that's already built into the table. The IRS can't build the disposal date into the tables because they don't know when you're gonna dispose it, right? They can only assume you're going to hold on to that asset through its depreciable life. So if we, let's say we sold it, well, let's go through. So let's say, yeah, so we got furniture. We bought it March 4th, 2021. We bought it for $7,500. Bought a bunch of furniture, $7,500. We sold it on, let's say, October 7th, 2024. Okay, so let's go through this. So furniture, what is the asset class life of furniture? How many years do we depreciate it over?
7.
7, right, so 7 years. All right, we're gonna assume that we're gonna use the half-life. Half-year, half-life. So the half-year convention, during the year that we purchased this furniture, we did not purchase more than 40% of our assets in the last quarter. Maybe it's the only thing we bought. All right, so depreciated over 7 years. So let's look at year 1. Year 1, This is 2021. So we're gonna take the basis, 7,500, times, what's our percentage? What percentage are we gonna use? 14.29%. Which equals what? How much does that equal? 7,500, 14.29% of 7,500 is how much? I can't do that in my head.
1,071.75.
Okay, so year one is 2021. We're gonna take $1,071.75. Let's look at year two. 2022, year two. 7,500 times what percentage? 49, right? And how much is that?
1836.75.
Okay. Year three. What are we gonna multiply it by for year three? 17.49? How much is that?
Thirteen eleven 75.
Ending up with 75. Alright, 2024. We sold it this year, didn't we? We sold it October 7th. We're using the half-year convention, so it's as though we sold it June 30th. Right, so we can only take half a year's depreciation. So 7,500, we're still gonna use the 7,500. What's our percentage that we're using in the fourth year? 12.49. But we have to take half of that percentage. So what is 7,500 times whatever half of 12.49% is? Alternatively, you could also multiply that by 12.49 and then just divide that by 2. If you want. Divide the percentage by 2 or divide the result by 2.
$468.38.
Alright, 468.38. So there's how much depreciation we would take in each of these years for a 7-year property. Again, this is for year of disposal. If we hadn't disposed of it that year, then we would multiply this by 12.49%. We would keep depreciating it for the whole year. Alright,
So would you add all of those together, and that's gonna be your total? Like, if you have to do in homework, is it gonna
well, if you
Anything
were
like
to
that?
take, so if you were to, this would be how much the total depreciation deductions over the years would be. Right? Now, I'm kinda getting ahead of myself, but you would need this information, you'd need to know the total. What's the sum of all of those?
4688.63.
0.63?
Yep.
Starting basis was 7,500. Depreciation taken 48.88, is that right? 48? 46.88, sorry. 0.63.
Yep.
This is our adjusted basis. So our adjusted basis for that furniture is now 28,1137. Remember I said a basis can be adjusted upward or downward, upward by improvements, downward by depreciation. So if we were to sell that furniture, let's say we sold it. When we disposed of it on October 7th, we sold it to somebody. We sold it for $4,000. We then subtract our adjusted basis. This is chapter 7, by the way. So you won't have this in this chapter. So we're here, 63. Somebody help me with this.
1188.
1188.63. This is our gain on the disposal of that asset. That's what we have to pay, and we would have to pay tax on that gain. Think about it conceptually, right? Okay, so we paid $7,500 for it, and then we got a tax benefit of $4688.63, right? We reduced our taxes as a result of this by $4688.63. Then when we sold it for the $4,000, so the difference between this $28,1137 and the $7,500 is that depreciation that we've taken. Now when we sell it, we're getting a tax benefit essentially for the rest of that amount, because we paid for it. Essentially it's like taking all the remaining depreciation when we sell it, to reduce the sale price, and then the gain, the amount over and above that adjusted basis, is the amount that we have as a gain. Like I said, I'm getting ahead of myself. Don't focus too much on that right now, because we're going to talk about that in chapter 7. But just so that you know, this total, even though yes, we're taking these in individual years, we do want to know the total amount of depreciation that was taken at the point that we sell it. That's when we're going to need that information, okay, to determine any gain or loss. If this was less than so if this was 2,000, we sold it for 2,000, well, now we have a loss, right, of, did I get that right? 811. Do I have that right? 811?
Yep.
So now we have a loss. And we get a further tax benefit then from that. Because we spent the money, we're recovering that expenditure over time through the depreciation. But ultimately we didn't recover all of it, because we ended up selling it at a loss, and at that point we get to recover the rest of it. Oh, I lost my thing. Okay, so let's look at the rest of these other tables. So that was the half-year convention. But we've got other tables that we have to look at. Half-year convention, we only have one table. Woohoo! Yay. The mid-quarter convention, though, we have 4. Why on earth would we have 4? One for each quarter, right? So, use the same example for this. Mid-quarter convention, we have four tables. First one, and it says right up in the title, placed in service in the first quarter. So we would use this table in the year that we placed it in service. right? So we may be using a different table, one of the other tables, if we dispose of it in a different quarter. We disposed of it in the fourth quarter. So in the year of disposal, we may be using a different table. The fourth, so again, we looked at 20 years, 3, 5, 7, 10, 15. First year, second year, third year, fourth year. All right. So we still have this furniture, but we'll say that we had more than, in the year that we purchased it, we had more than 40% of our personal property purchases took place in the last quarter. Even though we didn't purchase this in the last quarter, we purchased it in the first quarter, but maybe we bought, we bought other stuff, and most of it was purchased in, or not most, but at least 40% of it was purchased in the fourth quarter. So, easy black. Again, it's 7-year property. So we're gonna use the same column. Right? That column's not gonna change. It's only gonna change if it was a different type of property. If it was a car, or if it was a computer, then we would use the 5-year column. Right? Or if it was some property that was a 10-year or 15-year, we'd use a different column. So let's just say it is the furniture. Let's look at year 2. Mid-quarter convention, year 2, and again, we'll just stick the $7,500 for it. So in year 2, what's the depreciation percentage? What are we gonna multiply this by? $21.43. And this is there's year 2. So it's 7,500 times 21.43%. Should have used 10,000. Okay, so in year 2, we're gonna take $1,607.25 in depreciation. Let's look at, I don't know why I did these backwards, but let's look at year 1. I guess because I did it backwards in the last one. So year 1, 7,500 times what? 25%. How much is that? 3,750 divided by 2. How much? 1835? 75. 1875 and 0 cents? That's how much depreciation then we would take in year 1 and year 2. Okay, so same deal. We bought it March 4th, 2021. We're on the right table here, right? So this is what we're gonna use. So, and we sold it in 2024. So let's look at, now we're using mid-quarter convention. Year 1, 2021. All right. So we're gonna take, what's the math on this one? 7,500. You already did it over there, right? Times 25% equals 1875. This is our depreciation deduction here. Let's look at 2022. Year 2, again, 7,500 times 21.43, 21.43% equals 1607.25. All right, 2023 is our third year. 7,500 times what percent?
15.31.
15.31% equals how much?
1148.25.
Can you see the declining balance and the how it's worked in here? We're starting out with a large amount of depreciation and it's slowly getting smaller. Same thing when we use the half-year convention. These, here you see the opposite. The percentages are higher when we start and they get lower. You can also see when we switch to straight line. Look here for the 7-year property, 8.75, 8.74, 8.75, the 0.4 obviously is just rounding. 5-year, 11.01, 11.01. Okay, we never switch to straight line for the 3-year. The period of time is too short. But if you get to these longer periods, you can see it even more. So in the 5th year, for 10-year property, we switch to straight line. Here in the, also in the 5th year, we switch to straight line. 4.459 in the 7th year for 20-year property, that's when we switch to straight line. But you can see, you don't have to try and determine when we switch to straight line. The tables build that in. Okay? Okay, so 2024. All right, this is where we get a little bit complicated. Still a 7,500. That's the easy one. All right. So now we're gonna, and I said it wrong. We're still gonna use the same table. I think I said we're gonna switch to a different table because but this is when it was placed in service. So it was still placed in service during the 1st quarter, even though we are disposing of it in the 3rd quarter, or 4th quarter, right? So missed it by a few days. So still gonna take 7-year property. Now we're in the 4th quarter, 10.93%, but we can't take that full 10.93%. Because that 10.93 is assuming we owned it all year, and we didn't own it all year. We stopped depreciating it in the middle of the 4th quarter. On November 15th. How many months have passed in that year up to November 15th? I said 15th, right? I said 15th.
10 months.
10 full months plus half a month. That is 10.5 over 12. 10.5, that's the proportion of the year that we owned it. So however many months we owned it, in the middle of that month, or in the middle of that quarter, that's what that's gonna be our numerator. So if it was the 1st quarter, we would have depreciated it for a month and a half, right? So we would be using 1.5 over 12 of the year is how much we're depreciating it. If it was in the 2nd, so this is the 1st quarter, 2nd quarter, we would use 4.5 over 12. Is that right? 5.5, sorry. 5.5, because it's May 15th. In the 3rd quarter, we'll add, let's see, so it's the middle of August, so, get that right, 5, I'm sorry, no, you're right, it's 4, or I was right, it's 4, and you were about to correct me, so you're right. 4.5, because 4 full months would be the end of April, and then the 0.5. August is 7.5, right? 12. And then the 4th quarter is, what did I say, 10.5? 12. Is that right? 3, 3, 3. Adding 3 months each time. That's the fraction that you use to determine how much you multiply this by for the full year. So we could do this separately. What's 10.5 divided by 12? Or you could take 10.93 times 10.5 and then divide it by 12. So what percentage does this turn into? Hmm?
Round.
Well, yeah, you'd round it to. What's the percentage though here first? So 10.93 times 10.5 twelfths.
It's 9.56.
9.56. All right, so 7,500 times 9.56. Okay, is that right? I see it.
Yeah,
Plus-
she just got the wrong answer, so I showed her what I did.
Oh, okay. Do you guys know how to do that math? I can help you with it. So there are a couple ways to do it. I mean, you can. Say 10.5 divided by 12 is 0.875, and then multiply that times 10.93, and that's the percentage we're gonna use. So 9.5635. Oops. That way you can see it. $717.26 is the amount of depreciation we would take in that last year. Total depreciation. How much are all those added up?
$5347.76.
All right, so our adjusted basis, depreciation, 5347.76. 0.24, oops. How much?
2152.
Here's our adjusted basis. Right? And if when we disposed of it, we sold it for 3,000. We then subtract the adjusted basis to determine the gain. 2152.24, so 76. What is it? 47 probably. One. What do we have here? Sorry, 1847. Is that right? No,
It's just 847.
just 847. Right. Here's our gain. 847. Questions about that? It's just remembering that last year, if it was disposed of during that year and you're still depreciating it, if it's fully depreciated, this is a 7-year property, if we sold that furniture in year 10, well, we're no longer depreciating it, right? Our adjusted basis now is gonna be 0 because we've taken all the depreciation that we can. So anything we sell it for is gonna be a gain. Questions? so that's the, first quarter. Like I said, there are 4 of them, all depending upon when you purchased it. Here's property placed in service in the second quarter, placed in service in the third quarter, placed in service in the fourth quarter. This is all mid-quarter convention. All right, and then we get into straight line. So let's take a look at this real quick. So again, you gotta find the right table based on when you placed it in service. What quarter did you place it in service?
That's when they buy it, right?
What's that?
Placed in service, like, is when they buy it.
Yes.
Okay.
Yeah. When they, I mean, technically speaking, you don't start depreciating until you actually start using it, but, yeah. All right. So this is, remember those 2 are only for personal property, but real property, we're using straight line. This table is for 27.5-year property. It's up there, but it's kind of cut off. You only use one table for that. You're gonna see for this table, this is 27.5-year property is gonna be for residential real estate. If somebody is living in it, use 27.5 years. Nobody is living in it, well, if it's to be used for living in, I should say, use 27.5 year. If it's not intended for somebody to live in, you use 39 year, which is a different table. But for this is residential, 27.5 year, straight line. And you can see that from the table. I mean, there's some rounding in here, 3.7, 3.6, 3.7, 3.6, 3.7, 3.6, but it's the same percentage every year. After the first year, and not including the last year, unless you completely depreciate it. Well, even when you completely depreciate it. So, let's just say we have a building, we have a rental home. And we bought it for $200,000. Well, first thing you would do, and this is, I think chapter 8, we'll talk about this a little bit. If this included land, we would have to take out the value of the land. Because remember, we do not depreciate land. We only depreciate the building. So if we had land, so let's just say that. So total price was $200,000. Land was $50,000. We're gonna take that out. We're not gonna depreciate it. So our depreciable basis is $150,000. Okay? So we bought this piece, this rental home. Depreciable basis is $150,000. You'd still enter the land on the depreciation schedule because you don't want to forget about it when you sell it, right? You want to make sure it's there because that's going to be part of your basis in the entire property. But the only part that we're going to depreciate is the building itself. You can see each one of these columns, now it's only 27.5 years. So we don't have the 3-year, 5-year, 7-year, all that stuff here. It's only 27.5 year property. But what we do have, each of these columns pertains to the month in which it was placed in service. January, February, March, April, May, June, July, August, September, October, November, December. Month placed in service. The only time that really matters is in the first year and the last year. But we're starting in the middle of the month. So if we placed this in service, let's say we bought it on June 17th, 2021. June is which month of the year?
6.
month of the year. Find the 6. All right, first year, we're gonna take 1.97%. That's how much depreciation we're gonna take. Okay, so year 1, I'll go in order this time. Year 1, 150,000 times, what did I say, 1.97? Oh, let's go this way so that I can make another column here. Times 1.97%. How much is that? How much? 29,500? Wait, 29,51?
29.55.
55, okay.
Sorry.
Okay, so in year 1, we're gonna take $2,955 of depreciation on that rental property. Year 2, $3.636. Which is how much? How much is 150 times 3.636?
5,454.
And 0 cents?
Yep.
Okay. Can you guess what it's gonna be in year 3? Same thing, right? In year 4, in year 5, in year 6, right? Only difference is then gonna be in the year that we sell it. If we sell it before we fully depreciated it. Chances are we probably will. Who holds on to real estate for 27.5 years, even if it is business property? Right? And we'll do that in just a second, but let me show you the last column, or the last row in this table. So you can see in the last row, now we go up to 29 years, even though it's 27.5 years. I don't know where the half came from. I really don't. Just to make it difficult. So if you were to dispose of it in this 29th year, you would take no depreciation up through, what is this, 1, 2, 3, 4, 5, the June. And then, or not if you still had it, I'm sorry, not if you disposed of it, if you still had it. And then depending upon when you purchased it, you'd get this amount. So if you bought it in December, remember you only got a little bit of depreciation that first year. You only got 15 days worth of depreciation that first year. So that's why if you still have this property, you're gonna get more depreciation in that last year, because you only got the little tiny amount. Okay? So let's say we sold it. So again, this is the mid-month. Basis is 150,000. This is our mid-month audit.
617.
21, let's say we sold it, 8, 12, 24. Okay, so again, year 1 is 2021, 150,000 times, what did we say here, 1.97%. And we had 29.55. Deduction, it's a deduction. Alright, 2023. Third year, 150,000. I don't know if it goes up. It probably does switch to 37.
Why do they do those so close? 3.637, 3.736.
Well, actually, this one, they've used the 636 in the first 9 years exclusively, it looks like. So, we'll use 3.636. So we can use the same amount. $54. And then in 2024, which is our fourth year, 150. Now we gotta do this funky little calculation. Again, 3.636, but we sold it August. Middle of August would be, how many months will have passed in the year? 7.5, right? To July is 7, and then half of August. 7.5, 7.5 twelfths. What's that percentage? .2.
725.
Okay, multiply that by the 150,000. That can't be right. 150,000 times,
Oh, no, I did it wrong.
that's right.
Yep.
3408.75. All right, so the total depreciation, I mean, it would be the same thing. You know, we take the total depreciation here, subtract that from our basis, that's our adjusted basis. Any gain or loss is gonna be based on how much we sell it for, minus that adjusted basis. So when we sell it, presumably we're selling the land too, so we get to add that $50,000 back on to the adjusted basis, yeah.
So if this was sold, say on August 1st, we would still use August 15th?
Yep.
And if it was July 31st, July 15th?
Then it'd be 6.5, yeah.
6.5.
Mhm. Yep. What else do I want to say about this? Questions? There's an example in your textbook, but I'm not gonna go through that. Essentially just an example. Okay, make sure you've got the right table. Now, this is the 27.5 year. I'm gonna show you the 39-year table, which is essentially the same, but they have condensed all the years in the middle for the 20. This is the 31.5 year. Remember, we don't use this one anymore. Here's the 39-year table. So you can see, I don't know why they didn't just do this for the 27. Well, I guess
Well,
they're,
No, the sevens at the end.
the difference, right, the kind of the difference. But this one, they're able to just condense years 2 through 39 here. Okay. But same idea, same concept. Okay. Questions?
Is that it for depreciation?
You're funny. Well, for maker's depreciation, yes, although there are a couple of things, other things that we have to look at. Now you can see why I think this should be its own chapter. right? Good question. Okay, so, let me do this, I'm gonna break this up a little